After central bankers took centre stage this week, what did we learn about rate policy in 2024 and what does the future hold? Welcome to Market Insight, I'm Ramzan Karamali. Well, we got a hawkish cut from the Fed, a hold from the Bank of England and still no hike from the Bank of Japan. But it was the commentary from Jay Powell, Andrew Bailey and Katsuo Ueda that focused investor minds. So what should we expect from them all next year? Well, to help answer that and more, I'm joined by George Buckley, Chief European Economist at Nomura. George, thanks so much for joining us. Well, let's start in Europe. Last week, the ECB cut rates for the fourth time this year, and it looks like 2025 may see a similar picture. Do you think that's right?
Absolutely. We think they're going to continue on a meeting by meeting approach and cutting each meeting at that all the way through to the middle of the year. Maybe a final cut in September just to finish off, and that would take us a little bit below what we think is a neutral range. We think neutral maybe between 2 and 2.5%. So if we got all the way to September, that would take us to 175 if they skip one meeting, and that would mean slightly supportive interest rates for the economy.
Why do you think they're so confident to be able to cut rates that quickly?
A few reasons. Central banks generally, and particularly the ECB, have been much more focused on the growth outlook now that they seem to have a much better handle on inflation. Services inflation, as we saw, surprised on the downside in the latest month for November. I guess we'll have to see what happens over the new year when we get the next lot of inflation data. But lower inflation, weaker economic growth, the PMIs are still looking pretty weak, and I think all of those indicators suggest that they should be cutting interest rates reasonably quickly.
Now let's turn to the Bank of England. It's a bit of a different picture here. What are the big challenges for policymakers in 2025?
Well, the decision we've just had this week, I think, really does illustrate how interesting this central bank is at the moment. We had earlier this week some inflation numbers which surprised the Bank of England, at least maybe not consensus, but surprised the bank on the upside when it came to services inflation. That's the part of inflation they're really focused on right now to determine what's happening in the underlying economy. You had wage growth, which another very strong print for a second time in a row. I doubt that they'll be able to look favourably on that if it happens again in January. So those two events are really telling us that they can't cut interest rates that quickly, certainly not as quickly as the ECB in our view. And that's why we think the bank is going to be somewhere between the ECB and the Fed. They might not go as slow as the Fed, but they certainly won't be going as quickly as the European Central Bank when cutting rates.
Well, you mentioned the Fed there, and I believe from your own macro outlook for 2025, you think there'll just be one Fed cut. Why is that?
Yes, just one Fed cut. And one of the reasons for that is because, of course, we are waiting to see what a Trump presidency would bring. Based on our own forecast, we think that's going to bring tariffs. It's going to temporarily push inflation up. Now, for central banks like the European Central Bank, which is looking at these inflation prints, thinking, well, we've got a good handle on that. We've got a really weak economic outlook. We can afford to keep cutting, even through any inflationary-induced tariffs. That's probably not where the Fed is right now. Output is doing exceptionally well. You've seen that by the divergence in the PMIs, for example, and inflation. They're still worried, clearly, from this week's revisions to the projections. They're still clearly worried about last mile issues.
Now, the Bank of Japan also had its say this week. No hike this time round. But how confident should we be that the next meeting will actually deliver a hike?
Well, we actually changed our view based on the fact that Ueda-san was certainly talked about the possibility of delaying the hike even further. And as a result, we now don't think that they will raise interest rates until March. So we have a hike in March, we have a hike in October, and then another one to finish off in March of next year. But that's obviously not a very speedy increase in interest rates. One issue is that, of course, if the currency, and it has obviously weakened since the decision, the combination of what the Fed did and what the BOJ didn't do really did push the currency down. Obviously, that could actually end up pushing them into an earlier hike, rather strangely. So there is a risk that they go a little bit earlier. There's a possibility they go in January, but we think on balance they'll wait till March.
Well, we'll have to wait to see if your predictions come true. George Buckley from Nomura, many thanks for your thoughts. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.